Brilliant. Right. Hello, everyone. All right, just to check, can you just pop a little message in the group just to confirm that you can hear us and see us and everything's okay? I've got someone typing away, so that's always a good sign. Yeah, brilliant. Hi, Joe. Charlie's here. Hello. Charlie's one of our students at the Art of Finance, and I told him that he'd absolutely love this webinar because it's right up his street. So yeah, nice to. And yeah, hi Jonathan. Brilliant. So you can hear us, which is awesome. So thanks for joining us today. Our webinar today is the Monopoly of Markets. So just to check, obviously you can hear us fine, so that's fine. We're all sorted there. If you've got any questions throughout today, then just pop them in the chat box there. We'll either pick them up as we go along or we'll do them at the end. Obviously, the more questions, the better, because the more you ask, the more you get out of the session. For some of you know me already. I've become quite a familiar face. For others that I haven't met before, I'm Emma, and I am a trainer here at the Art of Finance, and I've been in the industry for more years than I care to remember, probably over 13. And I've worked in power planning roles, trainee advising, administration. And so it's, yeah, really good to sort of be touching on a subject today, which we've seen a lot in the news of late. There's been a lot going on. There's been emails through this morning about America. There's been obviously all the inflation news and things like that. So I feel this is a very good topic to be covering off this afternoon. I'm just going to pass you over to James, who is our guest from Fidelity, who's going to host today.
Thanks very much, Emma. Yeah, and thanks for joining on a sort of sunny, warm afternoon, and hopefully can make it worth everybody's time this afternoon. As Emma said, I'm James. So I've been at Fidelity for 7 years, and probably my main role at Fidelity is touring the country and speaking to wealth managers, financial advisors, para planners, anybody connected to the industry about our latest views on the world. So as Emma said, if there's any questions, put them in the box. I will probably leave questions to the end, and then we'll sort of just so we don't get dragged apart, but ask any questions at all and be delighted to answer those. And I've called this the Monopoly of Markets because everybody, I'm sure, on this call has played Monopoly. And if you've played Monopoly before, you know you need 3 things to win. So you need some luck, you need a good strategy, but crucially, you need to control your emotions. And now this was evident in the Bird household over Christmas, where we didn't just have disagreements over Monopoly. We didn't just have a heated argument. We had actual live tears on Boxing Day. Now, I know that sounds a bit sad for Boxing Day in the Bird household, but when I think about markets at the moment, as Emma said, there is so much going on that actually balancing your strategy for investments, of course, you need some luck, but also the emotions, your own emotions and your clients' emotions, I think becomes increasingly important. So in terms of the next sort of 35 minutes or so, I'm going to kind of focus on 3 key areas. So on the left-hand side, I'm going to focus on the here and now, and we're going to think about some of those key geopolitical events, inflation, central bank monetary policy, and think about what are those talking points to try and hopefully make your jobs a little bit easier. We're then going to take a forward-looking view and think about actually what do you do in terms of building portfolios. I'm not going to go into loads of technical detail here. We're going to keep it really light touch and just give some kind of broader ideas. And then I'm going to really look forward. I'm going to look at cryptocurrency. I'm going to look at the metaverse because I'm getting a number of questions across the market on those topics. And hopefully in true Monopoly style, we will take a chance and have some fun with that. So before we get into that, I thought it would be a good idea to start by recapping what's actually happened so far this year. It's been an amazing year so far for world events and domestic politics. And going from left to right, of course, the COVID restrictions being eased, it very much feels like, you know, after 2 years of probably an incredibly tough 2 years for everybody, hopefully we're starting to move past COVID. I saw a news article this morning saying that there's something called monkeypox that has just arrived in Italy, and I thought, don't even get me started on another infectious disease. But I'm glad to see that we've moved through that. It's been a tough time for politicians. Rishi Sunak was the most popular chancellor on record at the height of the pandemic. He's now gone to the bottom of the pile. Again, there's been different stuff for different MPs. We've all seen the stories about the MP looking at tractors in the Commons. And I won't say too much about that, but it's probably a tough time for politicians. We then had Will Smith slapping Chris Rock at the Oscars. And of course, there was a big debate about, was that real? Was it not real? Energy prices, they're going up. The average energy bill is going to go up by nearly £2,000 per household this year. So everybody feeling that inflationary pain. And of course, the French elections, Macron won that quite easily in the end. We've had the local elections here in the UK. And one theme I'm going to explore today is I think globally, there is a real push towards wanting something different from politicians. And it'd be interesting, I think, to see how that plays out in the coming sort of months and for the rest of the year. So that's been the year so far. And if I sort of move on and start with probably the biggest theme on people's minds at the moment, and for me, I think that's the Russia-Ukraine conflict. I think the first thing to say is a very sad situation. It's been a real tragic humanitarian crisis. And it sort of reminds us just how tough these events can be, not just for us as investors, but I just think for the wider world. The first European land war since 1945, and when I sort of think about what happens next, and the key question everybody's asking is what's going to happen, what's going to be the outcome of the war. I think it's incredibly difficult to predict. I think trying to predict geopolitical events, whether that is elections, wars, there's no edge, there's no advantage, there's no polling that you can do that gives you an insight. So what we do, or what we can do, is look at what's been the impact on markets and on the economy. So I'd kind of highlight 3 key points. The first thing I'd highlight is we've seen that MSCI and other index providers have removed Russia from the index. So if you've been buying an emerging markets passive fund or an emerging markets active fund, you will have seen in the last 2 to 3 months that Russia exposure has been written down to nothing and has been reallocated across the globe. So to places like South Africa and Saudi Arabia. So that will have had an impact on your clients' portfolios in the first half of the year. The second thing I'd say is what's going on in Ukraine and Russia at the moment is having a real impact in terms of that inflationary mix. And of course, lots of that is around commodities. So the price of oil touched $130 a barrel. That's the highest level in 15 years. But it's not just about oil. The price of wheat continues to rise. Food prices are at their highest level globally for over 12 years. And again, when you think about this big worry around energy inflation, when you start to add in food inflation and other forms of inflation, this is a really difficult time for policymakers to try and get that under control. Now, what makes it even harder, and the third thing I'd mention, is the likelihood of Europe tipping into recession, I think is now high. If you think about the economy that is essentially reliant on people spending money, it's reliant on businesses delivering earnings. When you've got a war going on in the background that ruins people's confidence, increases the price of everything, it's now likely that we are going to head into a recession by the end of the year. Now, just to kind of, without trying to confuse everybody, one thing you might be reading about in the press is something called stagflation. This is a world where you get high inflation and low growth, or a recession. Those two together are a really, really difficult mix for investors to deal with. Now, it's not just a difficult mix for investors, but it's also a difficult mix for policymakers. Now, what this chart here does, it looks quite busy, but bear with me. It goes back to the 1950s. And essentially, when the line goes up, that's showing you when the Federal Reserve was putting interest rates up. When it comes down, shows when they were cutting rates. And if you take a look at the red squares, this is showing you that 10 of the last 13 rate hiking cycles have ended in recession. Now, of course, that doesn't give me much confidence when you know at the moment the Bank of England have just put rates up to 1%. The US are speaking about 2 more half point rate rises in the next 2 meetings. And of course, the job of a central banker is to try and, at the moment, bring inflation down and not put the economy into recession. And that's what we call a soft landing. So if you hear about soft landing, it's bringing inflation down, but getting rid or removing that threat of a recession. What's interesting is in the last Fed minutes that we saw released yesterday or maybe the day before, Jay Powell, who's the chair of the Fed, he's now stopped talking about a soft landing, and he's now talking about a soft-ish landing. And I just want to put that into context, because imagine you're on a plane and you're about to land, and the pilot goes, "This is going to be a soft-ish landing." I'm not a nervous flyer, but I'd be feeling quite nervous about that particular landing. So, what this tells me, and it should tell us as investors, it's going to be a really bumpy ride this year. And I think volatility in markets, you're going to see a lot of swings, weekly, daily, monthly. So expect more volatility as the year goes on. Now, I mentioned this has been reflected in markets, and it just shows, what a difference 4 or 5 months can make. On the 3rd of January this year, the S&P hit a new all-time record high. Last year was a phenomenal year for markets. It was actually interesting. The S&P had a brilliant year. Amazingly, the best year or the best place globally was actually Mongolia, which returned 106%. Now, I'm not saying go and buy a Mongolian equity fund. I don't know if those exist, but it just shows that last year was an amazing year for markets. This year, things have completely changed. So the question you might be asked is, well, why have things changed, and what's kind of caused that worry? Is it all to do with the war? The war has had an impact, but it's more to do with the structural underlying factors in the economy. So when you put interest rates up, that affects the valuation of some of these big tech stocks that have been driving the market. We've also seen earnings have come under pressure. Of course, the war, supply chains, energy prices. But crucially, central bankers are removing that liquidity that they were putting into the market to support the economy during COVID. Now, just to bring this to life for you, I'm sure everybody on the call has been to a good party before. And if you go to a good party and you walk in, say it's let's call it a summer barbecue. You might have a barbecue coming up this weekend, I don't know. And you go in, and sometimes they've got a big bowl of something which it's like very alcoholic, and everybody has a few glasses. And when you're at the party, you go, "God, this is pretty good." And you keep drinking the punch or whatever it is, and you think, "I'm having a great time." That was the economy last year, and it was drunk on liquidity and low interest rates. And at some point, you've got to get the Uber home and face reality of the hangover the next day. And at the moment, the economy is in that Uber home. That liquidity, the punch is being pulled away, and that's why I think the market is struggling so much this year. Again, just to put this into context for you, last Monday, everything in the market was down apart from 3 businesses, the makers of tinned food, toilet paper, and bleach. So someone somewhere is preparing for an Armageddon of the likes we haven't seen before. But I do think it is going to be a tough year for investors, and volatility is absolutely here to stay. So again, this is a bit of an open question. How are you feeling after Q1? How are you feeling at the moment? Are you feeling bullish like Mr. Monopoly, risk averse like Officer Edgar Mallory? Or you might be feeling stuck in jail, somewhere in the middle, not quite sure of how to kind of position or how to think for the rest of the year. However you're feeling this afternoon, I'm going to try and give you some ideas in the next section to try and bring this to life. So I've called this board domination. I was thinking about how do you win the game of Monopoly. I was speaking to my colleague, Tim Mason. I don't know if Tim's on the call, but Tim was telling me that actually cheating is the way to win Monopoly. I said, Tim, we can't cheat clients. So we've got to think about different ways to try and win and actually help portfolios. So I've come up with 3 areas. So one is cash. And for me, that's all about inflation and all about fixed income. I'm going to look at what we've called the streets. That's looking at the different outlook for different regions. And also hotels and houses, which of course, no prizes for guessing that's property and alternatives. So let's start with inflation. You'll be reading a lot about this in the press. And I thought this was really interesting. This is the year-on-year change in price for different parts of the economy from April last year to April this year. You've got different things. So train fares, 6%, home furnishings, 17% more expensive. Says a lot about the last lockdown. That one of my highlights was buying a new desk. It probably says shows how exciting that lockdown was. You can see fuel prices up by over 100%. And the good news is beer is only up by 2%. So at the moment, we're okay. But I did mention wheat prices earlier. So we'll see how that plays out. So inflation is absolutely here in a big way. Now, when you look at this on a bit more of a global scale, what we've done here is we've gone back to the 1970s. And it really, if you kind of sort of cast your eyes here on the sort of middle of the screen, this shows that inflation has really picked up compared to the last sort of 20 to 30 years. And you can see the story that we all know. Of course, UK inflation yesterday announced at 9%. So that's the highest level in decades. Now, what I'd say is what's driven inflation has been the war, it has been energy prices, and it has been supply chain disruption. But crucially, I mentioned liquidity. What's driven inflation globally has been the amount of money that was printed by central bankers. Now, if you think a bit of, again, go back to that punch bowl analogy, if someone's printing more money and that money's being spent on projects, on fiscal projects, which is government spending around the world, being used, spent by companies, put into the stock markets, it pushes the price of everything up because you've got more money in the system. Now, when you start taking that money out of the system, of course, it has a real impact in terms of what happens to the inflationary outlook. Just to put that into context for you, last year, 40% of all the dollars in existence were printed last year. So this is really, a strange inflationary environment. The question I get a lot from paraplanners, from everybody in the market, is what's going to happen next for inflation, and that's like trying to guess what the weather will be like next week. It is notoriously difficult, and my sense is if central bankers can get that putting interest rates, if they get that bit right, I think you might see inflation start to fall towards the end of the year. So again, there's lots of unknowns around the war, around commodity prices, but I wouldn't be surprised to see maybe 1-2 more very high prints, maybe 10, 11%. As we move through into the autumn, we start to see that fall back towards 4, 5, 6%, and a longer term figure of around 2 to 3%. But again, when I deliver my next webinar for you before Christmas or this time next year, if I didn't get that right, apologies. That was not financial advice. Now, one of the questions I do get from planners is around, look, if inflation is high, do I need to be selling my bonds or my fixed income? Because we all know that bonds typically or historically struggle during times of inflation. And what I've tried to do here, I've tried to give sort of 3 different areas depending on your view of the market. So you might be a bond bear and think that actually inflation and interest rates will rise faster than implied by the market. And if that's the case, I'd be looking at a short-dated corporate bond fund. It has a lower duration profile. It feels a bit more like a cash product than a bond product. If you're perhaps thinking that actually central bankers might be a bit slower than the market thinks and you want some true diversification, I'd be looking at a sterling corporate bond fund, so maybe something in the UK. And this is a really bad joke, but if you're no idea, and if you don't have a strong view, what I'd say for your fixed income is use a strategic bond fund because your manager will be making those decisions for you, moving around through the asset class, moving duration around, moving credit risk around. So I still think bonds have a role to play. And I always go back to those kind of 3 simple reasons of why do we use bonds: source of income for clients, to lower the volatility of portfolios. But crucially, when you get a big sell-off in markets, bonds should hold up better than equities. It gives you that diversification. So I still think that bonds have a role to play, even with inflation nearing 10%. Now, let's leave cash behind and we're going to start moving around the board. This is the really fun bit. So we're going to start with China. China, interestingly, was the second worst performing market last year, second only to Pakistan. And that weakness has continued this year. So if you're thinking or you get questions around, why is China doing so badly? The first thing is the economy is really struggling. We had worries around the property sector last year, but China is the only major economy still doing lockdown. At one point, I think this was 2 weeks ago, a quarter of the whole of China was in some form of lockdown. So, just a staggering figure considering how free we now feel. That has a real impact on economic growth. The second thing to say is there's been a real regulation by the government around some of those big tech businesses. And again, that's really found its way into all parts of Chinese life. And it's amazing. There was a new rule put in earlier in the year. If you're a Chinese teenager, or no, sorry, under the age of 18 in China, you're now limited to playing video games for just 3 hours a week, not a day, a week. So again, you think people on video games, it's nothing. And actually, that has an impact on the profitability of a Tencent or an Alibaba or ByteDance who own TikTok. So that's the second thing. The third thing I'd say is we're starting to see the Chinese government are asking Chinese businesses that have listed in New York to delist and relist in China because they want more control over those businesses. Now, when any business moves the jurisdiction that it's listed in, it's going to make more volatility. It's never going to be a smooth process. So there's been a bit of a perfect storm when it comes to China at the moment. Now, again, on the back of this, question I've been asked quite a lot is, do you see China going the same way as Russia? They've got their eye on Taiwan. Is that kind of a reasonable assumption? And again, I'm not going to make predictions about the future of Taiwan, but what I do know is China has a much, much larger proportion of the world economy than Russia does. So this is your GDP figure by something called purchasing power parity. So essentially, it's a GDP figure, but it's more up to date. It's based on a country's demographic outlook, their economic outlook. And this shows that actually in blue, China is much larger than Russia. So when people say, okay, if China invaded Taiwan, we'll just cut them off. China is so integrated in the global economy. My view for this is, as Western governments, we've got to work with China over the coming kind of months and years. And I thought I'd try and summarize this for you because I think investing in China is a big opportunity, but it also holds lots of risks. So on the left-hand side, it really is a market with huge potential. This second point here, it's a retail-dominated market. It's got the fastest growing middle class in the world, and they've got this propensity to spend money. Now, I know what you're thinking. You can't spend money when you're locked down because you can only buy online stuff. So I get that. And I'm not talking about the here and now, but on a longer term view, I think this spending trend will pick up. And there was that amazing statistic that the Tiffany store in Shanghai after the last lockdown sold something like $5 million worth of rings on one day after lockdown. Now, I don't know. Everybody says that in the UK, lockdown made or broke people's relationships. In China, clearly, everyone was absolutely in love or something along those lines. I felt like they had to get married. But there's a lot of money there that's, of course, looking to spend in this new environment. On the right-hand side, I've mentioned policy intervention. What I'd say is it is a very volatile market. So this wouldn't be a market for low-risk clients. And again, I've put corporate governance. We've got a lot of analysts who live and work on the ground in China. And I think, what my one thing here would be, if you're looking to invest in China or in a China equity fund or an Asian equity fund, use an asset manager that has that local insight and has the local people that know the businesses, because it can be quite a confusing market. There's lots of local quirks. So having that local on the ground knowledge is really important in what can be, I think, at times quite a challenging market. And the other final thing to remember with China, it is a tech-driven market. This is more just to make you laugh. This is the first ever human flying drone in the city of Guangzhou. Apparently it goes 60 miles an hour. And I was looking at that and I thought, cool bit of kit. I'm not entirely sure I can quite imagine. I live in London. I couldn't quite imagine the skies of London with these everywhere. But it's a very technology-driven market. So again, it's just one to keep an eye on. And I think, if you're maybe your investors that are in accumulation or slightly younger, that've got time on their side, I would absolutely have some exposure to China in my portfolios. Now let's move around the board. The USA, I said, was the second best performing market last year after the mighty Mongolia, and actually lots of that was driven by some of these big companies that we all know. So WeWork, Snapchat, Uber, big tech companies. And now look, this chart looks like it's got a lot to it, but it's actually quite simple. So on the left-hand side, what I've done is I've plotted the market valuations of these businesses. So very, very high valuations. I've then plotted how many years of losses they've had over, all of them in over a decade worth of losses. I've plotted the revenue from 2020, and then this is the key bit here. How many years would it take them to erase those losses at 10% profitability, which is half the profitability of Apple? So it's quite a chunky figure. And it's just showing you that actually many of these big businesses that have been pushing up the stock market are actually very unprofitable and are unlikely to turn profitable anytime soon. Now, I think investors have started to cotton on to this. And that's why you've seen this year that actually, when I look at the S&P value indices, which is blue, and the S&P growth indices, so growth companies are these big businesses that you pay a higher price for. So the likes of Amazon, Apple, that have been in vogue over the last 12 to 13 years. Value businesses tend to be things like energy companies, utilities businesses, the kind of I call it old fashioned, but slightly, less techy areas of the market. And over the last perhaps sort of 4 to 5 months, we've seen a lot of investors start to look at value in the US and also in the UK, because they've realized that the profitability of these tech businesses can't just keep going on forever and ever. It's one of those things, I'm sure, of everybody rode or was investing in Bitcoin last year, and you think this thing's never going down, and then suddenly the bubble pops and it's now lost half its value. So again, if you are picking funds or you're thinking about it, I've seen lots of planners at the moment are starting to look at US value strategies to have I'm not saying sell all your tech exposure, but having some exposure will help if the market is quite volatile this year. Now, something that could make it volatile is the return of Donald Trump. This is one I think that is going to be a big theme this year. I spoke about political change. There's lots of dissatisfaction with Joe Biden, who's got the second worst approval rating in history. And when you think about actually, how likely is Donald Trump to return in 2 years' time, he's currently priced at 3-1 to be the next US president. And again, I'll say, if you go and bet on that, that was not financial advice either. So it just shows that it really is going to be an interesting time for politics over in the USA. Now, it's also going to be an interesting time in the UK. And I moved from one blonde politician to another blonde politician. And I thought, this is a brilliant photo. This was from the second week in January from The Economist. And it just sums up, the year Boris is having, really. And I'm not going to sit here and kind of bash Boris. The only thing I'll say is, I mentioned parties earlier. In my experience, Boris's line when he said, I was at a party, but I didn't know it was a party. I didn't realize it was a party. In my experience, you normally know when you've gone to a party. I've never gone somewhere and gone, oh, this is a party. I didn't quite, of all the kind of excuses, alongside being ambushed with a birthday cake and everything else, I didn't quite get it. So, look, it's been a tough year for politics in the UK. But actually, if you take a longer term view, this picture, I think, really sums up how investors have been feeling about the UK market. The UK market has been incredibly unloved over the last 6 to 7 years. And this is really reflected in this. So this is your price to earnings relative discount. And essentially all this is showing is what is the difference in price between the UK and the European market in blue, and the difference in price between the UK and the US market. And you can see on both measures, the UK market is considerably cheaper, especially from compared to the US. Now, investors have started to take note of this, and that's the trend and the line that you can see here in the last 4 to 5 months. The UK has been one of the most popular markets this year. And really my message here would be that actually, if you can look past surprise birthday parties and all the rest of it, there's a lot of opportunity in the UK. And I really think if we believe in the businesses in the UK, we can look past worries around Brexit deals and whatever it might be, there will be opportunities for investors on a longer term view. Now, let's leave the regions behind. I'm going to have a very, very quick word on property. I think property has been perhaps one of the biggest headaches for power planners, advisors, hotels and houses. If only it was this simple as putting hotels and houses on a board. It's been a headache because, of course, we've had liquidity worries. We've had worries about the gating of funds. My view on property is I wouldn't be selling my property fund. I think it's got a role to play as an inflation hedge, and it also gives you a diversified source of income. So I think hang on to your property if you've got property in your portfolios. I'd also be hanging on to my or looking at things like alternatives. Now, alternatives can mean anything from infrastructure to renewable energy, or even music royalties. This is the Round Hill Music Royalty Fund. And the orange bits that you can see, this plays on the growth of streaming. And it actually really demonstrates that vehicles like this that play on trends like the streaming of music can actually deliver returns for clients. And this pays a yield of 4.5%, and it's completely uncorrelated to financial markets. It doesn't matter if the market is up or down. If people are listening to music, this is delivering a return. Now, the only kind of word of warning I would say around things like alternatives is they can be quite illiquid. So I wouldn't be looking to invest in this directly or via a platform. I'd be looking to use an alternatives fund or even a multi-asset fund that might have some exposure to these kind of vehicles. But I think alternatives is something you'll be hearing about more over the coming months and years.
Mhm.
So, on to my final couple of sections, community chest. Sometimes you need a bit of help from community chest. I'm going to do 2 slides on ESG. This was a recent picture that was taken from the protesters at Goodison Park who said, just stop oil. The irony in this picture is that clothing is actually one of the biggest contributors towards global warming every year. So I'm not saying the protester should have been naked, but there was perhaps a bit of an irony in his particular message there. And I actually think when you look at global warming and this push towards net zero, one thing that isn't considered by the market is actually what could this do in terms of adding to inflation. I plotted 2 scenarios here. So on the left-hand side, this is a world where we get to net zero in the middle of next decade. This is a world where somehow we get to net zero during this decade. That is very unlikely. I'm aware of that. But it shows here that actually across both scenarios, we think any push towards net zero from policymakers is going to add to global inflation. Now, this is for 3 reasons. Firstly, any push towards net zero is pushing the price of carbon up. So we know that carbon price went up last year. It's continuing to rise as people are looking to find ways to decarbonize. We know that actually there's going to be environmental taxes on things like heavy industry. I think that will have an inflationary impact. It pushes the price of things up. And of course, the energy mix is incredibly tricky to work through. And, I'll caveat this, and I'm not going to say this is going to be an easy journey to net zero, because clearly, you've seen the news that Germany might be turning back on its coal plants, because I think for policymakers with the war, energy security in the short term means putting my coal plants on or using nuclear or whatever it might be. But actually, if you think about energy independence and security, the way to do that for a country is to use renewables, because then you don't need the oil from Russia. You don't need Russia's gas. And I think having that independence, I think for policymakers, will push things on over the coming months and years. It's also worth noting that we think climate change could have a real impact on asset class returns. These are what we call our SMAs. So there are market assumptions, but on a long-term scenario. So this is over the next 20 years. Now, the orange bar that you can see, RCP 8.5 extreme, that's a world where effectively we do nothing. We let the world burn, and that has a huge impact on asset class returns. Clearly, emerging markets are very exposed to climate change. And what I'd say on this one, and if you're thinking or you're looking at ESG in portfolios, for me, ESG is not about excluding businesses. So let's say I don't want to own any oil companies, and I go, fine. So I sell all the oil companies out of my portfolio. Emma, you might say, well, do you know what? I want to make a financial return, and I'm not as worried. I'm sure you are worried. You might not be. And you go, I'm going to buy those oil companies off James, and I'm going to make money. And when you exclude businesses, if you sell that business, even out of an index tracker, someone else has to buy it on the other side, if that makes sense, even at a reduced cost. So when I think about ESG, for me, the way to do it is engagement through active funds. How are we working? How are asset managers working with businesses to engage, to improve the way that they run, to help their journey to net zero? Because make no mistake, this is an incredibly complex area of the market, and I think as a human race working together is really the best way to do this. So on to the final 5 minutes, and I did say take a chance was the last bit. This can always go, it can go really well. Take a chance can also go horribly, horribly wrong. So look, let's have a quick word on the metaverse. If you haven't come across the metaverse, this is a really interesting area where people are meeting people, playing games online through a virtual world. And again, this has really kind of captured people's imaginations. Mark Zuckerberg, he renamed Facebook Meta and said that every meeting like this that we're doing now will happen in the metaverse in 5 years.
I
And
didn't know that
what
was linked to that.
Yeah, yeah. So it's amazing, and there's been some really strange sort of examples of this. So there's these things called NFTs, which
Mhm.
are non-fungible tokens, essentially virtual pieces of artwork that exist in the metaverse. Bonham sold one for $59 million last year, but you
Wow.
can't touch it or feel it. It's just in the metaverse. And I was informed by someone that a Gucci handbag costs more in the metaverse than in real life. And I hear some of that stuff and I go, it just can't be. How can that be true? Interestingly, though, Goldman Sachs say that the metaverse could be a $1 trillion market by the year 2030. What I will say is we've got a really interesting article on the metaverse about what it is, what's the investment opportunity, because it's quite complex and I struggle to get my head around it as
Mm.
well. And I'm only 31 and I'm going, oh, God, I don't get this at all. But um, if you, what I'll do is, Emma, I'll send that across to you when we're
Yeah,
back on
brilliant.
the email. And maybe if you could share it with everyone on the call, because it's just quite an interesting article to pick up and look at some of those opportunities. And
Yeah.
that, of course, leads to a quick word on um, blockchain, which, of course, the metaverse is built on the blockchain. And, you've got some quotes there about the future of Bitcoin. I think, look, let's always take a balanced view. When you think about cryptocurrency as an asset class, I think there's some big areas of concerns. The first thing is, what does it actually do? Is it an inflation hedge? Is it a store of value? Is it a play on the tech market? No one knows. So there's lots of uncertainty. It's very volatile. You will have been reading about the fact that Bitcoin fell in half. We saw the collapse of Luna, which was based on a stable coin last week. So, and I get worried when I hear stories of people putting everything they own into a coin that they don't understand. And I would always say with this stuff, do your research, tread with caution. Of course, what will come into this is regulation, and
Mm.
I think you know coins that are working with the regulator and are regulated and licensed to do business are going to succeed ahead of those that aren't. Because what the regulator wants to stamp out is me buying a cartoon coin with a cartoon fish on that people make loads of money, then the owners disappear and everyone loses their monies. And I understand that.
Mm.
I'm also very forward looking, and I'm also very conscious that this is here to stay. I don't think it's a one big Ponzi scheme. Interestingly, the fastest growth of any technology in history was the internet. So in 1997, the internet had 150 million users and was growing at 52% a year. At the moment, cryptocurrency has 150 million users, but is growing at 103% a year. So when you talk about adoption rates, it's still very early in the journey. If you think how quickly and how far the internet's come in the last 25 years, that shows we're still early. So watch with interest. But I always just think if you're investing, and I know you can't invest client money, but if you're investing your own money in these coins, just tread with caution, because I think I don't want you don't want you hear stories of people losing lots of money, and it's never a nice place to be. Anyway, on the subject of losing money, I'm going to give you all £200. We're going to go past go. Sorry, that's metaverse £200. It's not real £200. So that would be the best webinar ever.
Yeah.
Um, into some of the key takeaways. So, look, those key themes around geopolitics and central bank policy, inflation, they're going to dominate markets. Remember, it's going to be a volatile year. We looked at how to manage that. I don't think you need to be making drastic changes. Key messages: stay invested in the market. If you've got a long-term time horizon, zoom out, ignore the noise, don't go and buy bleach, toilet roll, and canned goods. And do keep an eye on some of those future trends, especially around the metaverse and cryptocurrency. I'm not going to do a big product pitch. All I would say is if you are picking funds or looking at some ideas, we've actually just launched these funds last June, and that have been really popular with paraplanners and advisors. The Fidelity Sustainable Multi-Asset Fund. So there's 3 funds here. They've got active and passive building blocks. And I know how important cost is to all of you on the call. They're priced at just 0.5% OCF. So what I'd say is these are not kind of dark green ESG funds. They're not, really dark green. They are funds for clients in retirement tilted towards ESG. So I think, finding a bit of a niche in the market. And if you want something, even cheaper, we've got the allocator funds. These are 5 funds, again, risk mapped across all the usual suspects, priced at just zero point 0.2 OCF. They're globally balanced. They are using passive building blocks. And again, they are rebalanced to their SAA, strategic asset allocation, every month. So again, just from a reporting point of view, makes your life a lot easier. If you're using Vanguard Life strategies, again, these funds have proved really, really popular across the market. So with that, I'll finish before we do some questions by saying thanks very much for listening. And remember my one bit of advice for the year ahead: don't go and buy a Mongolian equity fund. And Emma, I'll pass over to you for any questions.
Brilliant. Thank you, James. That was incredibly interesting. I don't know what you guys thought. Might be good to have if you've got any questions, then just pop them in the chat box and we will go through them. Yeah, it's a very interesting world out there, isn't it, at the
It
moment?
is.
There's
It
a
is.
lot to
Yeah, and I think I think what people forget is that a pandemic is a once in a century event,
mm,
and we haven't had a war in Europe since 1945. And I think people kind of sometimes just forget about the fact that actually these events, it's so rare that everything comes together. So I would just say when things get tough and there's a lot of reasons to worry at the moment, I go back to the basics of just zoom out. Remember, we're on a long-term journey as investors. If you're checking your portfolio every day, it's you're going to just end up making yourself really nervous that it's down 20%. It will come back at some point. Just keep that long-term view.
definitely. I think that's probably from my experience working within a firm, especially during the pandemic, and I can potentially see it happening again over this next year, is you're going to be getting those investors calling up and saying,
Definitely.
sell everything down to cash. And then you're there going, no, don't do that.
Yeah.
Not that.
No, definitely stay invested in the market. If your goals are the same and your risk tolerance is the same, then it's a longer term journey.
Yeah, definitely. So I had a couple of questions which we had in before, and I think there is someone typing at the moment as well. So we probably have a question pop up.
Sure.
So when we're looking at sort of from an investor's point of view, how do you feel investors can position themselves for these big geopolitical events? So obviously elections, Russia, everything that's going on in America.
It's a really good question, I'm going to be honest and say I don't think you can position for geopolitics. I've always felt this, and the best example of this is go back to 2016 when Brexit happened, and no one thought that was going to happen, and everybody was betting on the pound, which responds to that stuff. No one thought Trump would win, and there was that famous bet. I think was it Leicester City to win the league in 2016, Brexit and Trump. It was like 2 million to 1 or something. And I just I always think they're called black swan events for a reason, because they're rare and you can't position for them. The best thing you can do when they happen is try to do as little as possible, and be as diversified as you can. And I think the last 6 months has taught us anything. For many investors, it's actually I need to be a bit more diversified than just having a US tech fund, bit Bailey Gifford. I need
Yeah,
something a bit different. Actually, do I need a bit of the UK in my portfolios? And it's just being as diversified as you can. And whether you are building your own portfolios, you might be using a model portfolio, or you might be using a multi-asset fund. It's worth just checking with your asset manager what's under the bonnet, and stay as diversified as you can, because okay, you might get the outcome of an election right. If you do, great. But for me, it's always a binary outcome. I don't think there's any real edge to it. So I'd say just stay invested.
yeah. Yeah, brilliant. I think that is somewhere where I've seen people fail in the past, which is they're kind of going, "Oh, I'm going to put it all in there," and then events like this
Exactly.
happen.
Exactly.
Isn't great. So obviously you've touched on some common themes which kind of we've got going on at the moment. Looking towards the second half of this year, what do you kind of think the big themes should be that investors are going to be looking out for? I can imagine we're obviously going to have, obviously, Russia and Ukraine is going to continue. What's going on with inflation and interest rates is going to be another key theme.
Yeah, it is. I mean, all of those are going to be themes, and I think what I'm looking out for is I'm kind of imagining, and this is complete kind of speculation. So this is just my view. This is not Fidelity's view, but I have a sense that towards the end of summer, moving through maybe into August, September, October, there will be some sort of ceasefire or deal between Russia and Ukraine. I don't know how that looks.
Mm,
I just know when it and my background was a history teacher, so
yeah, I remember.
I kind of I looked at this stuff, and when you have a war or you have an event like this, even with Russia as the aggressor, you have to be able to give Putin a kind of a bridge to walk back across, and you have to
Mhm.
be able to come to some sort of agreement. And I don't know how that looks, but I think at some point there will be some sort of agreement between Russia and the West. And when that starts to happen, some of those inflationary pressures that we're seeing that are coming out of Ukraine are going to start to dissipate. I have a sense that at the same time, the impact of central bankers raising rates now will start to be felt towards the end of summer, and we might
Mm,
get those two things combine to bring inflation down towards the end of the year. Now, I could be horribly wrong because I said how difficult this can be to predict, and you only
yeah,
need something else strange to happen to throw it all off course.
another
But
random virus.
yeah, oh yeah, the monkey. Yeah, would be a killer. But I think, um, I'm my sense is I think that will be what I'm watching closely is how does that inflation and end of war narrative feed in towards maybe September, October this year.
Mm,
You mentioned the virus, the outlook for maybe COVID. I mean, I you can never rule out another variant, or you can never
mm,
rule out something else coming down the line. Again, I'm not a scientist, I'm a historian, but I know from previous pandemics that in every pandemic in history, after 2 to 3, 4 years, the virus becomes endemic, it dies out, and it becomes milder. That's just the
yeah,
way viruses work because
mm.
when they move from host to host to infect more people, they have to become more virulent and less deadly. So, I hope we're past the worst with that because has been, I know for everybody's mental health, it's been really tough. So I'm going to stay positive and say no more
It's gonna
COVID,
be fine.
no more viruses.
Definitely. We're all gonna have really good bills of health and
Fingers
live
crossed.
long, happy
Touch wood.
lives. Everything's gonna be all fantastic and
Yeah.
yeah. Oh, brilliant. Thank you so much for that today, James. It's been so useful and I'm sure that's helped loads of our attendees today. Um, so just a quick touch on our next event. So you can join us again on the 16th of June, in which I will be joined by Royal London, and we're going to be discussing protection on that one. So pop yourselves on the website, get yourself signed up, ready for that one. A couple of bits on our side from the Art of Finance. Keep an eye on our website as well, because we are looking to improve that, and it'll be looking very new and having some amazing new features on it soon as well. But as always, any questions, pop us a message. And yeah, thank you for joining us today. And thank you very much, James, for that. It was very
No
insightful.
problem. Thanks for joining on a sunny afternoon. Hope everyone has a great day and a great weekend when we get there. Cheers,
Oh,
Emma. Thank you.
brilliant. Thank you.
Cheers.
Bye.
Thanks. Bye bye. Bye.